We start by reading the requirement. What is the total relevant cost? Important keyword. We know we are in decision making. We're talking about material, so we know that we have to follow the decision tree. Is the material in stock? Is it in regular use? If not, is there an opportunity cost? Okay, a scrap value. So we have to find out, first of all, how much do we need for this special project? How much do we have? That tells us how much we have to buy. And if we do that part first, well, we need 1,500 kilos. We have 945. Therefore, we have to buy 555. And if it's not in stock, it's always going to be at market price. And we know the market price is $4.25. Okay? Now, if we have something in stock, we have to ask, is it in regular use? If it is in regular use, well, we have to replace what we use at the current price. And the story tells us that there's nothing about using it. The only thing we would do is sell it at $2.75. So if it's not in regular use, then the relevant cost is the opportunity cost. That would be $2.75. The original purchase price, not important to us, right? That's a cash flow in the past, not relevant to my future decision. Yes, the financial accountants will like that for inventory valuation, but for my short-term decision, not relevant. Guys, you multiply across, do the math, and you will arrive at answer A. 4957.5. Let's read the requirement. We're talking about relevant costing once again. It's a theoretical question. It's evaluating the statements. So we only want the costs that are future costs, incremental, cash flows, or opportunity costs. We want to avoid the sunk costs, the fixed costs that aren't incremental, and any overheads, okay, that are allocated on a general overhead absorption rate. We have a company that's growing fruit that customers pick by themselves. We're thinking of hiring people to do the packaging so that people don't eat the fruit. And the total sales value of the fruit currently picked and paid for by the customers. Well, that's interesting for me because it's going to change if we package it ourselves. Cost of growing the fruit. No, that is a fixed cost. The cost of growing the fruit doesn't change based on how we pick the fruit. Cost of hiring the staff, that's an incremental cost. If we go with the option 2, we have that. And then comparing the value of the fruit picked and paid for by the customers, right, against these two, we could make our decision. The total sales value of the fruit if it's picked and packaged by the staff. So I'm liking answer D. Let's start with the requirement. Which components should the company buy in from outside in order to maximize its contribution? We see make or buy, a classic. Even if they said profit here, it would be the same approach. And what do we want to do? Compare the variable costs of making versus the variable costs of buying. The buy-in costs are given to us here on a silver platter. Unit costs are also given to us. And we see the standard trap, the standard trick. Remember, these overheads are there. Those are fixed. Somewhere else, we had our budgeted costs divided by some budgeted labor hours, and that goes into the unit cost to show the full cost per unit. We care about the variable cost per unit. So that would be 12 here, and that would be 18 here. We want to go with the lower of the two. Okay, so we will make A's in-house. We will buy the B's from our supplier. And we're assuming a short-term decision here. We're not looking at long-term strategic consequences of outsourcing. Are we going to then have lower overheads? Well, maybe, but that's not part of the question we're going with. Just comparing the variable costs. Answer, guys, B only.